Okay, so like I said, today's class we're going to be discussing leverage, risk per trade, margin, lot size, stop loss, pips, and points. So now today's class is very significant in the sense that it's going to be talking to us about risk management. Okay, now there's basically another class that talks more about risk, where we devote all our attention to risk. But these basically are the parameters of risk. Okay, these are the things to consider when we're talking about risk and risk management. Okay, this is what this class is about today. Really discussing the parameters, the rudiments of risk management. So when it comes to trading, right, the reason why we all want to trade is because we want to make money. That's very true. Okay, but then one important thing to also learn in the market is that you want to protect your money. You want to protect the monies that you're trading in the market. Okay, so Warren Buffett is probably the richest investor in the world, someone that's worth close to $100 billion, and he's made all that money through investing. So what he said, and he talked about how that he has this investment in several portfolio companies. Okay, he has a company that invests in other companies. So he basically holds shares of different companies. So one thing he said is this, he said he gives two rules to every CEO, the CEO that runs his different companies. He said he gives them only two rules. He tells them these are the two rules you always have to stick to. You always have to abide by. The first one is never lose money. The second one is never forget rule one. So the first rule is do not lose money. The second rule is do not forget rule one. Okay. So as far as he is concerned, you will make money if you don't lose your capital. You will make money if you don't lose all your money. That's what he is. So basically, that is true when it comes to trading or investing or anything that relates to investment. You want to first of all make sure that you protect your money, you protect the capital you are trading. Once that capital is protected, the profits will come in by itself. It will be like a natural consequence, a natural occurrence when the capital is protected. So that's why we talk about risk first and foremost. Before we talk about profit, we talk about risk. Because for you to enter into any trade, you are risking. You're risking. For example, if you were to do any kind of investment, the monies that you put into that business or into that investment is a risk. So you want to make sure that that risk is properly calculated, properly determined, it is thought through before you go into using that risk, right? So that's what this class is about today, and it's going to be interesting. So we're going to start with talking about leverage. So now we'll talk about leverage, we'll talk about margin. Let's start from margin, actually. Sorry for the arrangement. So we'll talk about margin. Well, it's not this is basically not in any particular order. Okay, these are just what we're going to talk about. It's not in any particular order. It's not as if we're starting from the first. So margin is basically the amount of money you come into the market with. Your own capital. Okay, your own capital is what's called margin. Your own capital is what is called margin. So when you create an account with Vantage Markets, and for those of you who have an account already, when you fund that account or the funds that you have put into that your account is what is called margin. That's margin, right? So for you to trade, you need to have margin. So let's say you fund your account with $1,000. Let's say you start with $1,000, and that's the funds that you're starting with. That's your margin. That's what you credited into your account. Now, you know that the way the forex market is set up, you can really trade. You trade. You have several. You have the market is built into what is called lot sizes and standard lots. And a standard lot is basically $100,000 worth of $100,000 worth of transaction. So a standard lot is $100,000 worth of transaction. Okay, so it's like 100,000 piece, 100,000 units, 100,000 units. So every trade is supposed to be broken into $100,000 units. So each one is a standard lot. Okay, but then there are other lots called, there's a mini lot, there's mini lot. So mini lot is 10,000 units. 10,000 units of currency. Somebody is writing on my screen, please. Minutes. I don't think I can manage that from here, please. So you 100,000 standard lots, 100,000 units. A mini lot is 10,000 units, and a micro lot. We have micro lots too. Micro lots is 1,000 units. 1,000 units. Okay. So in your on MT4 on MetaTrader, when you're trading, this is what you refer to as 0.01. You will see that they tell you 0.01 to 0.09. Okay, that's mini lot. Hold on, please. If you're going to be able to ask your questions, but let's go to the class first so that you'll be we'll go through. Then I can answer all your questions. So relax, I will answer all your questions. So you have 0.1. This mini lot, 0.1 to 0.99. That's your mini lot. Then standard lot is 1.0 all the way to, and so forth and so on. Could be up to 100 or more, right? So that's what these are the lot sizes that are used. That we said we'll talk about lot sizes. So these are like this is like the transaction sizes in the market. Lot size is transaction size. Okay, that's what lot size is. So I just brought that up front so that we'll talk about some other things before we go deeper into lot size. So there's no sound. Please, who can hear me? If you can hear me, give me a 1 in the chat. If you can hear me, please give me a 1 in the chat. Okay. Ayeni can hear me. Kehinde can hear me. Who else can hear me, please?
I can hear you, but I can't chat. I can hear you, but I can't chat.
Okay, fine. So if you can't hear me, just let me know. 2 people can hear me. TechnoSpark.
I can hear you.
Okay, great. All right, no problem. TechnoSpark, please check your stuff, or probably it's from your side. It looks like other people can hear me. All right. So now, like I said, we'll discuss that further. So when you fund your account with an amount, that's your margin. So that's your capital. But then the Forex market allows you to use what is called leverage. I said we're not discussing these things in any particular order. So the Forex market allows you to use leverage, and leverage. Okay, nice. So the leverage is basically the ability to power up your trading capital. So that you trade as though you have more than what you actually have. Okay. So you can trade like you have more capital. You have more capital. Than you actually have. Okay, so this is what margin and leverage does for you. So leverage allows you to power up your trading capital so that you trade as though you have more money than you actually have. So what does that do? You have how does that work? You have $1,000, like we said, you funded your account with $1,000. That's your margin. So now you are able to trade. Remember what we talked about lot sizes? We said every trade you take will fall into this category. It will either be 1,000, which is a micro lot, or it will be 10,000, which is a mini lot, or it will be 100,000, which is a standard lot. So you can only trade in multiples of these numbers. Okay, you can trade in multiples of micro lots or mini lots or standard lots. And then for what you can see here, micro lot is actually the smallest. All right. So, but how do you increase your ability to trade more? Because the more trades you are able to take, the more the size of trades that you are able to take, the more profit you can make. So if you have $1,000, that's a good amount of money. But then if you only traded according to your capital, you will only be able to take micro lots. If you use no leverage at all, you'll be able to use only micro lots. And then when you use micro lots, your profit will be very, very small. Your profitability will be very, very low. So that's where the broker introduced a leverage to help you power up your trading capital. So that you funded your account with $1,000, you can actually trade that account as if you have 10,000. So we see that 10,000 here, if you have 10,000, if you want to trade multiples of 10,000, you can use 0.1. So that means you can trade a $1,000 account, which falls under mini lots, normally, but you can trade it as a micro lot. You can trade as if you have 10,000. So that becomes a leverage. That becomes a leverage of 1 to 10. So if you have $1,000 and you want to trade 10,000 units or you want to make a trade of a $10,000 size, that is 1 to 10 leverage. That's a leverage of 1 to 10. You have 1,000, you are trading as if you have 10,000. That is 1 to 10 leverage. Okay, so that's what leverage does. And what the most important thing about leverage is that it helps you to increase your potential profits. So now, if you're going to use only one, if you trade without leverage, let's say you trade without leverage, you make $1. If you trade without leverage, let's say you make $1. But if you trade with leverage, you make 10 times that amount. You make 10 times that amount. 1 minute, guys. Okay, so when you trade that amount, let's say you trade your $1,000 as a mini lot, micro lot, which is actually where it belongs. But if you trade without leverage, let's say you make $1 per trade. When you make that $1 per trade, that's very small. But if you now are able to trade it as a micro lot using a micro lot size, a mini lot size, then you make 10 times that money. So that money goes to $10 per trade, which is 1% of your account that you just made in profit. And you know, if you place a trade and you made 1% of your account, that's good profit. Because all you need to do is make several 1%, and you are able to see a solid percentage on your account. So that's what it does. That's what leverage allows you to do or helps you to do, right? So, but one thing with leverage is that leverage needs to be used with intelligence. It needs to be used with caution, because leverage is a two-edged sword. It's like a two-edged sword, right? Leverage is like a two-edged sword. And what a two-edged sword is that it cuts in both ways. It cuts with both edges. What that means is that just the way leverage can help you make more profit, leverage can also make you make a lot of losses. It can amplify your losses. Just the way it amplifies your profit, it can amplify your losses. So there's an allowable leverage. Now, as a broker, Vantage allows you to use up to 500 pips, or up to 1 to 500 leverage. 1 to 500 leverage. Now, in certain circumstances, you can actually get 1 to 1,000 leverage. Now, the reason why, as a broker, we give this amount of leverage because there are people who know how to use leverage. Everybody is not the same. It's not at the same level. There are people who know how to use leverage. They know how to use leverage and then turn $100 to $1,000 to $10,000. The only way you can do that is through leverage. So that person who can do that is wise and intelligent with leverage. So leverage helps him to make his targets, to reach his target. Now, if you are not very experienced and you're just starting, we are giving you this allowance of 1 to 500. It's an allowance. It doesn't mean you have to use all the allowance. It just means that you need to use some of it. So 1 to 10, an allowable amount of leverage is 1 to 10. 1 to 10. When you use 1 to 10, you are perfectly good. Okay? So which means you have $1,000, you can then trade multiples. You can then trade mini lot sizes, mini lots. So you can trade as if you have 10,000 because you are using a mini lot with your $1,000. So that's very important. But for those who have the ability, they understand leverage, they want to use it to their advantage to make a lot of money. That's why we provide 1 to 500. Okay, and the more knowledgeable you are in the market, the more you may decide to use more leverage, but it's not necessarily important for you to use too much leverage. The best thing is to fund your account with a good amount of money, then leverage it by 10 times. Make it use 1 to 10 leverage, and then you are good. You are good to go. Okay, so that's the thing. If you use too much leverage, it becomes risky. That's when you see some people are in trades and their minds it's beating very fast. When you take a trade and you're using you are using a manageable amount of leverage like 1 to 10, you don't bother about your trade. You enter your trade, you set your profit targets, and then you walk away. You don't, when you sleep, even when your trade is running at night, you are sleeping well. Some people can't sleep when they have a trade on. That's why some people get this perception that when you are trading, you have to always be looking at it 24/7. It's not like that. The reason why people sit down and start looking at their trades 24/7 because they have over leveraged their account. So if you use too much leverage, that's what is called over leveraging. You've over leveraged your account, and you don't want to do that. When you don't over leverage your account, you place your trade and you're at rest. Okay, your trade will go and hit your take profits or your take profit targets, and you're good. You know that if that trade were to go against you, you also know what's the maximum you can lose on that trade. Because the way trading works is that trading works by you making more profits than you lose. Sorry. Let's say you have 10 trades, and you have every trade you take makes you a profit of $10. And every trade you take has a potential to lose you make a loss of $10 as well. You are right. Yes, of course, that's the way it is. So let's say you have 10 trades, you want to take 10 trades, and then you take 7 of those trades, and every one of those trades you are going to take has the potential to make a $10 profit. And if you were to lose any trade, it has the potential of losing $10 as well. So what you now need to do is work on your profitability. When you take 10 trades and 7 of them are profitable, it means you have $70 because we said that every trade is $10. We're assuming every trade is $10, okay, in profit. But every losing trade too is also $10 minus. Now you take 7 trades. Out of the 10 trades you're taking, 7 of them are profitable. That's $70. Then you take the remaining 3, those ones are losing trades. That means you lost $30. You have $70 in profit, you have $30 in losses. Cumulatively, you are in profit to the tune of $40. That's exactly how trading works. So whenever you place a trade, there's a potential that trade may not play out. But in the course of time, you understand that there are edges that you have where you have an advantage in the market based on the method that you use, based on the strategy that you use. And since you're just new to the market, that's why we have a Telegram channel where we put trades out for you. So you can actually start trading. You can fund your account, even though you're new, go through the preliminary trainings, and you can start taking trades because you are not doing the analysis yourself at this time. So this is more like you being able to profit while you are learning, being able to earn while you are learning, right? So it's very important the way trading works. Even if you lose a trade or two, doesn't matter. What matters is that you win more than you lose. So you don't want to now destroy your account on those few trades that you lose. You want it to be a situation where you lose a little, you make more. But there are people that every time they take a losing trade, their account goes to zero. Their account gets blown. Every time they take a losing trade, their account goes to zero. When you're like that, it comes to a point where it gets frustrating. It gets frustrating. So it looks as if you're in a losing game, but you're not in a losing game, really. That's not the way it's designed. Okay, it's not like a casino. No, this is actually real business that you can come in here and make your money and withdraw it and do good things with your money, right? That's what it is. That's the way it's designed to be. Trading is not gambling. It's totally different. There are two different businesses. Okay, so that's very important. Okay, so that's the idea of leverage. You want to use it sensibly. 1 to 10 leverage is what we recommend for you to use. Beyond that is getting too risky, except you're a professional trader. Okay, except you're a professional trader. Okay, I see you, Ayeni. I see your comments. All right, so except you're a professional trader who knows how to use leverage and multiply his money himself, then of course you want to make sure that you stick with the manageable amount of leverage. Okay, all right, so let's move on. Now we've talked about leverage. Margin is your capital. Risk per trade. Let's talk about risk per trade. Risk per trade. Okay, so now the risk per trade is important because this is what you want to consider before you enter any trade. Just like what I was discussing just now, I said every trade you want to take, you want to make sure that the profits you are taking, the losses you may take, you reconcile them so that overall you are in profit. So, but how do you make that happen? The first thing you want to do is you want to make sure that you determine how much you intend to risk per trade. How much do I intend to risk on this one trade? So you determine that ahead of time. It is advisable that when you're just starting, you use between 2 to 3% of your account. 2 to 3% of your account on every trade. Okay, it is advisable that when you're starting, you risk no more than 2 to 3% of your account. So what that means, let's take 3%. Let's take the high one. Let's take 3%. Okay, so we have this number, this hypothetical number where we say your margin is $1,000. You started with $1,000. So 3%, what this means now, risk per trade means that you are going to calculate 3% of your $1,000. That's what you are going to risk on your trade. That's what you are going to risk on the next trade you want to take. Okay, the next trade you want to take, you want to risk 3% on it. So 3% of $1,000, 3% of $1,000 is $30. 3% is $30. Okay, that's how much you are going to risk per trade. Now, these numbers I'm calculating, they are very, very easy for you to calculate eventually. By the time I've done the whole numbers now, you may look at it like, oh, am I going to be doing all these numbers before I place a trade? Well, number one, that's very important that you do it because, like we said, the first thing you want to do when you are investing, when you are undertaking any form of investment, in any form of investment or trading activity, the first thing you want to do is protect your money. We said that's what Warren Buffett said. If somebody who has made all his money over the course of more than 50 years, he has made all his money over 90 billion or $100 billion in investing, and he tells you something about investing, you want to listen to him. So we said that Warren Buffett said you shouldn't risk more than, you shouldn't lose money, don't lose your capital. And then he tells his people, don't lose your capital, number one. Number two, do not forget rule one. Rule one is don't lose your capital. Rule two is don't forget rule one. So you want to be able to calculate these numbers and make sure that you have tabs on these numbers. And that's number one. Number two is that these numbers are actually very easy to calculate eventually when you get used to it, which is very easy to get to. Okay, so don't get perturbed by the calculations we're doing. It's not a big deal. All right, so 3%. So you take that $30 and that's what you want to risk on the next trade. Okay? But the way the market works is that for you to be able to determine that you are risking 3%, for you to determine that you are risking 3%, there are some parameters you need to set. You need to give the market an order. Just the way when you come into the market, you say, I want to buy or I want to sell. You know, you want to be able to give the market an order that tells you that tells the market that if this trade were to go wrong, please, I don't want to lose more than $30. If this trade were to go wrong, we've said it before that you can make winning trades, you can make losing trades, but the only thing is your winning trades must be far more than your losing trades. So you don't want to destroy your account or lose your account or lose all your capital on that one trade or two trades that you may lose, right? So that's the reason why you want to determine your risk per trade before you start. So you gave the market an order and say, hey, market, based on this, I want to make sure that this my trade falls into this amount that I have predetermined. I do not want to see that this trade, if this trade goes against me, I don't want a situation where I lose more than $30 on this trade. Because the more money you lose on a trade, the more difficult it will be for you to make it back. So you don't want to lose too much on a particular trade. So if you make a losing trade on this first trade and it's $30, and the next one you make $60, you've already recovered your loss and made a $30 profit. Or if you lose $100 on the first one, and then you make $50 or $60 on the second one, now you are still in drawdown, you are still in loss to the tune of $40. You see, so that's why you want to manage your risk per trade. You want to take care of that risk per trade ahead of time. Okay, so for you to determine give the market, you know, we are trading on MetaTrader and on our apps and all, that's where we're trading. So how do we give the market this order, this direction order that, hey, this is how much I want to risk, no more than this. Okay, so now what we're doing is that we're going to use two things. Number one is our lot size, and then our stop loss. So we've talked about lot size before. What we said, lot size is basically, it falls into three categories. We have the micro lots. We have the micro lots is 0.01 to 0.01 to 0.09. That is the micro lot. You use that kind of lot size when you have maybe like $100 and above, 100 to 900 thereabout. That's when you want to use that amount. Okay. Then you have micro lots, mini lots. Sorry, mini lots. You can use mini lots when you have $1,000 and above. Then standard lots, when you want to do a standard lot, you should have $10,000 and above. That is using a leverage of 1 to 10 that we recommend for new people. Okay, so if you are new to trading, I'm recommending 1 to 10. These numbers I'm giving right now are for 1 to 10 leverage. Some people can have $100 and trade it with one standard lot. Okay, that's why we give this allowance of 1 to 500 leverage. Some people can have 100 and do it like that, and they know how to make profit from it. They also know that if that trade goes bad, they are going to lose the money, and they are ready for that. And if you are just starting, you are not ready for that. I can assure you, you're not ready for that. You want to make sure you are seeing growth, consistency, growth, and all that before you come to a point where your intention is to basically turn $100 to $1,000 in a day. Okay, so stop loss is like a predetermined point in the market where it's a market order. Stop loss is a market order It's an order you give the markets. To take you out. Okay, so basically, stop loss is an order that you give the market to take you out at a certain predetermined point. So what that means is this. If you're entering a buy trade, So we either buy or sell in this market, right? In this market, we either buy or we sell. Okay, I'm sure we already know that. We're either buying or we're selling. So if you buy a trade, if you make a buy trade, you are expecting price to buy or sell. So if you make a buy trade, you are expecting price to rise. That's what you're looking for. When you make a buy trade, the only way you make money from that trade is when price goes up. If you make a sell trade, the only way you're going to make money from that trade is when the price goes down. Okay, so let's do this. Let's say equals up. Then we say sell equals down. So when you make a buy trade, your direction is you want price to go up. When you make a sell trade, you want price to go down. But where a losing trade can come from is when you make a buy trade and price starts to come down instead of going up. Price starts to come down instead of going up. That is where you make a buy trade. Instead of price to go up, it starts coming down. So that's where you may make a loss. When you make a sell trade and instead of price to come down, it starts going up, that's where the losing trade comes from. So a stop loss now is a predetermined point you set. Usually when you make a buy trade, you put your stop loss at a point below your entry price, telling market that, hey, if price goes against me like this, because I'm expecting a buy from this, I'm expecting price to rise from this buy trade. If price doesn't do what I expect and it starts coming down, please close my trade here so that I do not lose too much. That's what the stop loss is. Then you are on a sell trade, you are selling a trade and you expect the price to come down. Instead of coming down, it starts to go up. So you tell the market through a stop loss order, hey, please, if this price tries to start going up instead of coming down, please close me out at this point. That point is usually be a point above your entry price on a sell trade. So please take me out on this trade so that I don't lose more than 3%. So a stop loss is an order that you are giving the market, telling the market where to take you out in case the trade goes against you, right? That's what the stop loss is. So now there are three parameters, like I said, for determining two parameters for determining your risk per trade. You have lot size, you have lot size, you have stop loss. So you determine your stop loss. So you determine the area of you want price to stop you out, right? So let's say now for us to calculate your risk per trade. So let's do some calculations now. Risk per trade is equal to lot size, So we know our risk per trade already, right? Our risk per trade is 3%. Now we know our stop loss. So our stop loss can be, let's take our stop loss for 300 points. 300 points. So 300 points is 30 pips. So we said we'll discuss pips. Okay, we'll get to that. But just know pips. Basically, pips is just to mention it ahead. Pips is called price interest points. PIPS, price interest points. It's just the measure. It's what it's like the unit for measuring price movements. Okay, pips is basically the units for measuring price movement. So when price goes up or down, you're measuring it in terms of pips. And that pips is what translates, that pips multiplied by your lot size is what translates to profit or losses or loss. That pips, which is basically the measure, is how you measure price movements. It's basically units for measuring price movements. Okay, the unit points price and pips is the unit for measuring price movements. Okay, so when you multiply your pips by your lot size, it gives you your profits. So let me just put that here so that we can go to the next one. Pips is the unit for measuring price movements. price movement. Okay, so now your profit slash loss equals pips times lot size times lot size. So now you notice I said points. You notice I said points, 300 pips, 300 points, 30 pips. So points, it's easier to do your calculations using points because the whole market right now is about points, right? So points is just pips times 10 equals pips times 10. So if someone tells you 10 pips, you know that that's 100 points, okay? But points is easier to use to do your calculations. When you are using pips, there are confusions you have. But when you're using points, it's you can calculate it very well. All right. So now we come here and we say we know, let's say our stop loss points when we enter this trade. Let's pick a hypothetical trade now and say our stop loss point is in pips. Okay, stop loss point is equal to, let's say, 300 points. Okay, 300 points. We've done that in the market and we say, hey, if price goes against me 300 points, please, I don't want to be in that trade, I cancel it. Okay, so 300 points is our stop loss point, right? So now we know our risk per trade already. Risk per trade is already calculated, which is 3% of $1,000. That's 3% of 1,000. 3% of 1,000 equals $30. Okay, so $30 is our risk per trade. Now we need to know what lot size am I going to use, because whenever you want to enter a trade, it's going to prompt you to select your lot size. If you are on your phone, you will see it as lots. Okay, if you are on your laptop, you will see it as volume. Whether you're on MT4 or you're on MT5, you will see it as volume. Volume and lots are the same. Okay, whether you're on your phone or your laptop, you see volume, you see lot size, so whichever one is the same. But you cannot place a trade without selecting your lot size. So you are going to have to select your lots. Let's say we are taking this trade now. We want to risk only 3% on our trades. We already know that our stop loss point is 300 points. So what are we going to do now? We don't know our lot size yet, because this lot size, this whole combination is what we need to give the market the complete order to tell the market that we want to risk no more than $30, which is 3.3% of our capital. So in order to calculate lot size, we now have this. We have risk per trade divided by stop loss point. Stop loss. Okay, lot size equal risk per trade divided by stop loss. So in this case, we have lot size. Lot is equal to 30. 30 is our risk per trade divided by 300. 300 is our stop loss points. Stop loss point is 300. So in this case now, I'm sure what we're going to do here is that we're going to have lots equals 0. I think that's 0.1, right? 0.1, yes, that's 0.1. So our lot size for this trade is 0.1. So when you want to enter this trade now, you enter your lot size. Your lot size, you put 0.1 there. You will see it there already. You just edit and write 0.1 there, or you select from the drop down. You will see it there 0.1. You select it. Then you put your stop loss as 300 points, and then you enter that trade. Okay. So this is what you want. With this now, you have protected that trade you are entering, and the market cannot do more than that. And so now, from here, once that trade, if that trade doesn't go to your stop loss, it will therefore move to your take profit. Okay, so it will now move to your take profit. It will now move in your favor. This is only done just in case it doesn't move in your favor. That's the only purpose of this. The only purpose of this is just in case this thing doesn't move in your favor. That's when you are That's when this is for. And because you are protecting your money, you want to make sure that you do this. Please, we shall appreciate if the record can do it. Yes, I will share the recording with you guys. I will do that. Okay, so this is what it's all about, right? And then it's very important that because you're protecting your money, you want to set your stop loss and tell the market, this is where I'm putting my stop loss ahead of time. Okay, so this is where, okay, I think we have gone through the class right now. Let me pause a little to ask questions. Okay, so I just want to add this. Now, when you enter your trade here around this point now, you enter for a buy, right? Good. Now, you want to locate a previous low. Now, I will not be able to explain that previous low in this class because it's not for this class. We'll explain it at a later class. So when you come, you want to put your stop loss at a previous low, under a previous low. It's like you're hiding your stop loss behind the low. You can put this down somewhere. We will come to this class again where we explain what highs and lows are, right? So you put your stop loss below this area, and then the reason why you're doing that is because you know that if price doesn't go up the way you expect it, and it eventually comes down, if price doesn't go up and it eventually comes down, what you want to be able to do is you want to make sure that price doesn't go beyond this area, because if it goes beyond that area, you are now confirmed wrong. You are now confirmed wrong. So the trade should close out in negative so that you can maintain your capital. Okay. So you leave that trade and move on to the next trade. So the distance between where you enter the trade and the point you take as stop loss will usually be measured. You can measure it. Okay. So let's do something here. So I can measure from here to here now. So from here to here. Even though these numbers, this thing I didn't really do it properly. So from here to here now is 731 points. You can see the minus there, minus 731. I'm sure if you can see my scale, you see 731. So that 731 is your points, is the number of points. So you can see this is very large, very, very large. Okay, so but let's just say that that's the point from the entry to the point you took as stop loss is 731 points. That is the point that you are going to use now as your stop loss. So this area now where this point is, you will not trace it here. Trace it to that number. You see 102.857. That is the value you are going to impute into your stop loss area when you are entering that trade, because there's a place that is provided for stop loss. This value right here, because you've already calculated it, 102.857. That's the value you are going to take and then impute it into the area that is provided for your stop loss. Do we understand?